So I want to talk now about Keynesian open economy macro policies. Before, in a previous video, I talked about the relative effectiveness at increasing GDP, stimulating the economy under fixed and flexible exchange rates, using fiscal and monetary policy in a Keynesian framework. So this is a table that I filled out before, but now I want to go into more of the analysis of why it is that monetary policy is not effective with fixed exchange rates. And I want to also note that this is basically a kind of ISLM model. For those of you who know what that means, that's great. If it doesn't mean anything to you, that's okay as well. But this is basically a version of the ISLM framework with fixed prices and wages, so a short-run Keynesian story, with a small country in international financial markets. So it's going to take interest rates as given by the international market. So let's start. I'm going to start with a particular one, which is monetary policy. So monetary policy under fixed exchange rates. In a lot of ways, this is the easiest one to do. So what we're going to do is we're going to look at the policy. We're going to look at the initial aggregate demand impact. This is basically the closed economy effects. We're then going to look at the balance of payments pressures associated with these changes. We'll ask whether it's a fixed or flexible exchange rate, then go into the secondary GDP impact, and we're going to see that either the policy is thwarted by the exchange rate market, or it's exacerbated. It's more powerful. So in the case of increased money supply, okay, so this would be, for example, through an open market operation or printing money, whatever. What we're going to see, as we've talked about before, is that the initial impact is that you're going to have lower nominal interest rates because there's more money in circulation, more currency in circulation. That drop in interest rates is going to make it easier to buy homes, expand businesses, buy cars, and that's going to increase aggregate demand, and so the GNP tends to be increased by the monetary stimulus. Okay, so that was the end of the story with the closed economy. We now have to look at the impact on the foreign exchange markets, and I'm going to do this in the following way. I'm going to focus on GNP's impact on the current account balance. Now, current account is imports and exports of goods and services. Increased economic activity is going to result in more purchase of goods and services from abroad. That tends to cause the current account to go into a deficit. So there is an impact on international transactions through the increase in national income, or GNP, associated with the money supply. The drop in the interest rate is going to tend to make the domestic bonds less attractive to foreign purchasers. So you're going to tend to have a deficit in the private financial accounts balance. There will be less demand for our bonds because the interest rates are lower. Now, one of the things that you see about this is both the current account and the financial account balance are both in deficit. Now, as we've learned in a previous video, that a deficit in these two is going to essentially mean that there'll be excess supply of domestic currency in the foreign exchange market because you are buying more goods, services, and assets from abroad and exporting less. So what you have is pressure for depreciation. Okay? This policy, the increase in money supply, is going to tend to put pressure on the domestic currency to fall in value. Now, here's where you ask whether it's a fixed or flexible exchange rate. If it's a fixed exchange rate, this excess supply of domestic currency in the foreign exchange market cannot lead to the depreciation. The central bank must intervene to prevent that depreciation from occurring. So, with fixed exchange rates, again, it's this fixed exchange rates, this pressure for depreciation will result in the central bank buying domestic currency in the foreign exchange market. So what they do is the money that they woke up in the morning putting out into the market, say through an open market purchase of assets. So they bring in assets, domestic bonds, push out domestic currency, starting this process going. What you're going to see is that in the afternoon, the pressure for depreciation, the excess supply of domestic currency in the foreign exchange market has to be countered in order to keep the exchange rate pegged by buying the domestic currency in the afternoon. That is going to cause the money supply then to drop, directly counteracting the initial policy choice. So what you have with the monetary policy with fixed exchange rates is that the requirement to peg the exchange rate makes monetary policy really completely ineffective. So if you want to tie the hands of a central bank, let's say that you're a country where the central bank has pursued inflationary policies in the past, and you want to tie their hands, fix the exchange rate. Fix the exchange rate, and they will not be able to have an independent monetary policy. So that is either a good thing or a bad thing, depending on whether or not you want monetary policy to play a role. But the bottom line is the increase in the money supply through the peg exchange rate turns around and negates everything that was done to start the process. So fixed exchange rate, monetary policy, completely ineffective in a Keynesian open economy.